Good evening, everyone. My name is Henry Gamble with SimplerOptions.com, and in tonight's free video I wanted to take a look at a couple of airlines. So one of the biggest themes, and you don't have to go very far to find a headline to find something talking about it, is how, or the theory, that cheaper crude prices will equate to better profits for airlines because of course they're able to save on fuel prices. That's all very sound and good analysis. The only problem for me is when you find a situation where it seems like everyone is banking on the same idea, sometimes it can get a little tricky, especially as you head into earnings, which a lot of these airlines are facing. So as I approach these, I say, okay, I like this, I would like to play them to the buy side, but I don't have the conviction, and really I never would do this around earnings anyway, to come in and buy a directional call. But what are some other ways of looking at this? Whenever I approach an earnings trade, I try to think, how can I get myself into the smallest risk scenario if I'm wrong, and then the largest reward if I'm right? Some of the best strategies that I have found for that are butterflies. So when I look at this daily chart of UAL, a couple of things that I like to do is first I'll note that it's in a daily squeeze. Anytime you have an underlying that's in a daily or a weekly squeeze heading into earnings, I like to give them the benefit of the doubt that they might move a little bit bigger than I expect. Of course, there's no guarantee that it's going to have a big move, but it's something worth taking into account. It's something that makes me look at the chart and say, okay, the trade here is not to come up and sell a one standard deviation call credit spread or try to turn that into an iron condor or anything like that. I want to try to play it so that if it explodes in one direction or the other, I can try and capitalize off that. Like we said, I am going to play this to the buy side for the reasons we've discussed with crude, and because the underlying is in a good bullish trend as well. And then a couple of things that I like to do to actually start structuring the trade. First of which is just measuring your previous swing high to swing low. What this does for you is give you a 1272 extension, which is one of the fib ratios that we like to follow, and it also gives you an area where you can start to try and piece together your strikes. So when I look at this, the 1272 extension is not far from where we're trading, which makes this not an ideal trade, but it's not bad. What you're trying to do is get this to be as close to your extensions without going too far over them, and then lining up your butterfly to take advantage of that. So the way that I was looking at this, if we bring over an options chain and other things that you can factor in to help you make these decisions, not only are you trying to use your extensions to say, okay, if this does have a good report, these extensions should help keep it at bay, but then you're also trying to use the expected move, which in this case is right here around $2.60. So you're saying that if these extensions are any good, and the expected move holds, well then we should see it stay within this realm. Now, if we're wrong, how can we try and protect ourselves? And the strategy that I like the most here are butterflies. So in this case, we've done this where you've got $4 wide on the 68.72 side, $3 wide on the 72.75, and what the best case scenario will be for this strategy is that we can get as close to 72 as possible without going over. If we do, of course, then we have the 75s here that will act as our protection strike, and then of course stay above 68. I like these strategies because when you look at it and you notice this was the 68 call and we paid $1.20 for it, well then that puts our break-even price at $69.20. You'll notice that's exactly where we closed the day. So this is a great way of taking premium in from those out-of-the-money calls, buying intrinsic value from this in-the-money 68, and then of course tacking on the 75 to protect and define your risk. So I like those trades much more than doing something like the outright purchase of a call. They are more forgiving if you're not right, and they're still a great way of taking advantage of implied volatility. So of course UAL is out tomorrow morning, so that trade will be more from a management perspective, but the next time you see something like that show up, and we do have plenty of airlines on the horizon, it will give you an idea on how to play it. So that's what I've got for today's free video. I just also wanted to make you guys aware, depending on what time you're seeing this, the video or the course may already be started, but Bruce is doing a course on double diagonals tonight. This is Wednesday, January 21st. Even if you're seeing this a little bit after the fact and you can't participate live, the recording is still available on demand. So if this is something you think you're interested in and you've done any classes before with Bruce, I think we've had very good feedback from him and a lot of people really like his style. So that'll be tonight if you're interested. And otherwise, we will see you at the next free video.